What I want to do is to take you through some of the progress that's been made since the collapse of Lehman Brothers in 2008 on the improvement of our financial system. And I'm going to take you through the core part of the plumbing. If you don't mind the plumbing metaphor, there are a lot of new pipes and valves that some of you may not be aware of. We're talking about the core of the financial system. So these are, for example, this is the interbank market. These are very large financial institutions like Goldman Sachs, JP Morgan, Citibank, Deutsche Bank, Barclays, and so on. They're connected to each other through the interbank market, and they serve the role of moving risk and liquidity and capital through the economy from one part to another. So ultimate borrowers lend money to borrow money from ultimate lenders. Risk transfer occurs through securitizations, derivatives, and so on. These banks do that work for the economy. And as we found out in 2008 and 2009, when one or more of these banks becomes dysfunctional, the entire economy suffers. And that's why these banks are too big to fail. And despite what you may be hearing, they're still too big to fail. So we have to do something about that. We're going to talk a little bit more about that. This is an example of a very fast failure. This is Bear Stearns. The vertical axis here is how much money Bear Stearns could send out at a moment's notice. It's called its liquidity pool, and it basically disappeared. And when it disappeared, Bear Stearns could not continue business. It became dysfunctional, and all of the clients that it had, its hedge funds, its derivatives counterparties that had been relying on it, basically could not continue. So if you will, think of the financial system as kind of a black box. It doesn't, as it's often criticized for not producing anything, but let me tell you, if that black box doesn't work anymore, the rest of the economy suffers because it's necessary for transferring risk and liquidity. The first big changes in the plumbing of the financial system came during that crisis when the Fed and other central banks not only continued to provide liquidity through their normal channels, but they opened up entirely new pipes for taking securities out of the banks and replacing it with cash, or taking securities of one form and replacing them with treasuries and other liquid securities, so that the banks could then continue to provide liquidity to the rest of the system. Another big piece of plumbing that was put in connected different central banks. So the US entered currency swap lines with all of the major central banks in the world, allowing them to have access to US dollars that they could provide to the banks in their locales so that they could continue to provide liquidity in dollars. And you might ask, well, why couldn't they just go out and buy dollars on the market? It wasn't a question of buying dollars, it was a question of borrowing and lending dollars, and they were shut out of the market for borrowing dollars overseas. I'm going to spend quite a bit of time on what I consider to be the most important piece of plumbing in the financial system. Now, I know, because I see a few friends in here, that there are a few experts in the audience, but I'm going to assume that we need to talk about this from the beginning. Okay, so we have a large dealer on the right. That could be Goldman Sachs, JP Morgan, Citibank. These all operate massive broker-dealers in securities. And every night, they need to borrow enough money to finance their inventory of bonds, government bonds, some equities, many other securities, about 100 billion apiece for the top 3 or 4 every day. Staggeringly large numbers. And how do they get financing for those securities inventories? They do it through what's called the tri-party repo system. How do they do that? They post those securities. They actually put them in accounts at a clearing bank. And once those securities are there, they serve as collateral for loans from cash investors, principally money market funds like Fidelity, Vanguard, and the like. So it's these money market funds that are essentially financing the Wall Street dealers. What's changed in this plumbing? Well, first of all, what was wrong with this plumbing? And then we'll talk about addressing that change. The first thing that happened, oh, by the way, as I mentioned on my title page, I have some conflicts of interest. I have one on this. I'm working as a consultant on litigation between Lehman and JP Morgan over some of the things that went wrong here. So just be aware. I don't want you to get the view that I I don't have any conflicts of interest at all, but I'll try to be straight with you. A clearing bank, there are only two of them in the United States, JP Morgan Chase and Bank of New York Mellon. So these are basically responsible for the largest piece of plumbing in the financial system. If they were to fail, that's basically it. We would have no more liquidity in our financial system of any sort. In the middle of the crisis, as Lehman approached its failure, JP Morgan Chase and Bank of New York Mellon obviously were of concern to the New York Fed. So it became apparent that those two, that big circle there was so critical to the performance of the financial system that it could not be allowed to be exposed to the credit of the dealer. Now, a moment ago, you might note an inconsistency. A moment ago, I said, well, these are loans from the money market funds to the dealers. I didn't say that they're loans from the clearing bank to the dealers. So where's the inconsistency? Well, every night, the money market funds lend to the dealers, and the next morning, there's, as I said, hundreds of billions of dollars in these loans. They mature, and they go onto the books of the clearing banks until late in the afternoon, and then they get lent out again back to the dealers from money market funds. In the middle of the day, they are effectively loans. They are literally loans from the clearing bank to the dealers. And when the extent of these exposures of the clearing banks to the dealers became apparent, the New York Fed insisted on a reform of this piece of plumbing so that the clearing banks were not in harm's way. On one side of this problem is the fact that the money market funds are very flighty investors of cash. We haven't, I'll bet you that almost everybody here has a money market fund. Every time you invest $1, it shows up as another dollar in your account. And every time you take out $1, it looks like it's $1 for $1. It's always $1 per share. Well, that's partly because of the accounting of these money market funds. When you sell one share, they'll call it $1 worth, even if the actual market value is slightly more or slightly less than $1. It's called stable NAV. But don't get carried away with the word stable. It's quite possible for these money market funds to lose money if the assets that they invest in, like repo with the dealer banks, those cash loans I mentioned a moment ago, it's quite possible they can lose money on those investments. During the financial crisis, one of them, called the Reserve Primary Fund, lost about 3 cents on the dollar to Lehman. And when it did, that's called breaking the buck, as you may have known. When it did, not only did they lose investors in their money market fund, but essentially the entire U.S. prime money market fund business started to suffer massive outflows, about $400 billion in 2 weeks, out of about $1.5 trillion. And this would have continued to the meltdown of this core part of the financial system had the Treasury not guaranteed all money market funds, something that they have pledged not to do in the future because of the moral hazard associated with promising to make up for any losses that are incurred by private investors. There are two proposals on the table. One has been proposed for some time, which is don't let investors cash in or cash out at $1, cash in or cash out at whatever their shares are worth, just like an equities mutual fund. And that's a good idea because if an investor thinks that they're $1 as long as they're cashing out, but if they're too late, there won't be enough to pay everyone, so they have to move faster, that's going to encourage a run on these money market funds. So going to a floating net asset value, there's no fiction about getting out at $1. You'll get out at whatever the market value is. There's no need to rush any more than you would rush out of an equities fund. Not to say you might not rush out of that. The different proposal that I'm part of, which is a proposal of the Squam Lake Group, is to put a buffer on these money market funds so that they have to hold extra capital to back up these claims at $1 apiece. The industry insists that it wants to have this dollar for dollar accounting. Then the risks associated with busting through $1 should be covered by some capital. This is currently generating a lot of controversy. It looks like our proposal is now the front runner in terms of how to reform this part of the plumbing of the system. But the Investment Company Institute, which is the institute of money market fund sponsors is quite concerned about the costs of this proposal. So there's a big debate going on in Washington about this right now. So that's on the cash lender side of this system that I described. That's the left-hand side. On the right-hand side, as you may know, all of the investment banks are now regulated banks. They now have access to the Fed for liquidity, and they will soon have much higher capital requirements, meaning they have to hold, just like the money market fund proposal, they have to hold more capital to back up the risk that they're taking. In the middle, where the tri-party clearing bank is, the Fed wants to get that circle out of the credit provision in this system. They want it not to take the credit intraday. So they've introduced a reform, which I'm not going to take you through in the interest of time, which will stop this process each morning of becoming the lender to the dealer bank until the afternoon when these repo deals are rewound. With the new plumbing that they're introducing, they will step out of that provision of providing credit to the clearing banks almost entirely. However, there are still concerns that the late afternoon transition is dangerous, at least in an extreme situation. And speaking for myself, I'm not entirely pleased with the reform, how it's going. So I think it may have to go another way. The president of the New York Fed, Bill Dudley, also spoke recently to the Bretton Woods Committee, suggesting that this reform of the tri-party clearing bank infrastructure is not going well enough. And between the lines, one might surmise that he would like to see a different way of improving the system as well. So we can come back to this in Q&A. I'm going to leap through some of the technical details associated with how to make that tri-party clearing bank step out of that credit relationship and simply act as an agent but not a principal in this deal. And I'm going to talk about the next major piece of plumbing that's getting reformed, with your permission. By the way, can everyone hear me at this point? Yeah? Good. By the way, this is what happened at Lehman in this market. These are the quantities of credit it was getting through the tri-party market. So it started at 180 billion a few days before they went under. And just before they went bankrupt, where that vertical line is, no one would lend to them anymore. This is the most proximate cause of the entire financial crisis, is the inability of Lehman to roll over its overnight securities loans through the repo market. That is, the cash borrowing to finance their securities. And that's, as I said, the most important thing to fix. The next piece of plumbing that needs to be fixed, in my view, is the prime brokerage plumbing, by which a large dealer bank, the same few that we spoke about earlier, there's only about 12 of these large banks that really matter in all of these examples. Could be Goldman Sachs, JP Morgan, Citi, and so on. These large dealer banks offer brokerage services to hedge funds, which are essentially the same as the services that you get when you invest stock through a broker, but this is on a much different scale, at least for many of you, maybe not a few of you. The hedge funds roll over very, very large positions. Now, in order to get financing for the securities that they buy, the hedge funds borrow money from the dealer banks using as collateral the securities that they are buying. So when they go long short on something, the dealer bank is actually sitting on those securities positions and under US law is permitted, subject to restrictions, to taking those securities and then using them as collateral for loans to themselves. So if it was Goldman, they could take a loan, they could borrow money using as collateral securities that had been left with them by a hedge fund. Now, if this is done very carefully with the restrictions in the US, it can work. But I will show you why it didn't work in the financial crisis of 2008, 2009. One of the problems is that London does not have these legal restrictions that limit the use of this repledging of customer assets. I want to show you some data for Morgan Stanley, which almost went under 2 days after Lehman failed. This is, the vertical here is how many billions of dollars of securities were pledged with Morgan Stanley on each reporting date before Lehman failed and after Lehman failed, that Morgan Stanley was in a position to repledge to others. And all indications are that they did repledge essentially all of it. So from before Lehman's failure, which is September 2008, to after, there was about a $600 billion reduction in the amount of securities that Morgan Stanley could use to finance itself based on what was left with it by its hedge funds. The hedge funds were leaving in droves from Morgan Stanley, and the only thing that saved it was massive liquidity provided by the New York Federal Reserve, as we now know. In fact, the New York Fed, with good reason, didn't want to release all this information immediately afterwards because it would have scared the living daylights out of anyone that had credit relationships with Morgan Stanley. A Freedom of Information Act request was made at the time to find out how much Morgan Stanley received in liquidity from the Fed and find out about Morgan Stanley's financial condition. That information was litigated. Whether that information would be revealed was litigated and just recently was revealed. And I want to show you the extent of what we now know about Morgan Stanley's liquidity pool. I showed you how Bear Stearns and Lehman's ability to provide liquidity to itself essentially disappeared. Morgan Stanley had a very close call. The week before Lehman failed, it had $180 billion effectively that it could wire out the door at any moment. That's its liquidity pool. And the week after, it had $91 billion. That's an $85 billion reduction. And you've all heard about all of the different ways that runs can occur, everything from depositors lining up outside the bank to over-the-counter derivatives and everything else. Well, by far, the biggest run at Morgan Stanley was in the form of hedge fund clients who packed their bags and left. 56 billion of that loss of liquidity was associated with those hedge funds reaching in and taking back their assets, not allowing Morgan Stanley anymore, of course, to use them as collateral for loans back to Morgan Stanley, and not allowing Morgan Stanley to use the excess cash that had been left with it. The rest of the categories are important, but not nearly as important as that. So this is the second, in my view, I'm ranking these 1, 2, 3, the second most important source of systemic risk facing the financial system still. Tri-party repo being number 1. Although it's being fixed, I remember the fix is not necessarily going to work. Number 2, there's been no changes here. I've talked to regulators in London. They're not changing their lack of rules on this score. And so far, we have no changes here in the United States on this one. So if you're writing to your congressperson, this one is a good one to talk about. The responses of the hedge funds have been of 2 types. So if I was a hedge fund and I was worried that Morgan Stanley would send out my assets and I wouldn't get them back, I would probably want to have dual sourcing. Just like Apple Computer gets its chips from 2 different places, I might want to have 2 different prime brokers, so if one got in trouble, I can move my assets to another. Well, you can imagine that might be okay for the hedge fund. It's probably not going to help the bank that turns out to be the weaker of the 2, because that makes it even easier for a run to occur. The other approach is to take those securities and cash and set them aside in a custodial account in the title of and the name of the hedge fund so that they can't be used for financing purposes by anyone. They just have to sit there. Now that has disadvantages because it means you can't get as much leverage as a hedge fund. If you can't get margin loans on your assets on the basis of those assets being used to finance the prime broker, then you're not going to get as much leverage. Both of these techniques are now being used, but this is purely voluntary behavior by the hedge funds. Again, keep track of your questions. We're going to be finished in a couple minutes, well, 3 or 4 minutes, and then we'll open it up for your questions. The last thing, the third on my list of most important pieces of plumbing to be fixed is what's known as central clearing. So this one is not as bad as it looks. On the left-hand side are 3 major participants in the derivatives markets. And you've heard all about over-the-counter derivatives. So these are things like interest rate swaps, credit default swaps, energy swaps, equity derivatives, commodity derivatives. There's 600 trillion, that's with a T, amount of assets whose risks are transferred through derivatives just like these, over the counter. There's about 400 trillion more traded on exchanges. The way that the system has been working is on the left-hand side, where in this case B owes A 100 million on a mark-to-market basis, A owes C 80 million, and C owes B 90 million. These are pretty big exposures. Well, if we make it with B's rather than M's, it's even bigger exposures. And those numbers are not unusual because, as I said, it's a $600 trillion market, which is almost entirely intermediated by about 12 banks. 99% of it or so is intermediated by about 12 banks. So along comes the Dodd-Frank Act, riding to the rescue, and says, we don't want these bilateral exposures. They encourage run behavior, and they create systemic risk because these large amounts of potential loss could cause one of these firms to go under, and that could be damaging to the entire economy. So henceforth, and this henceforth keeps slipping further and further into the future because it's very hard to implement. Now the latest date for implementation is July 2012. It could slip again, but henceforth, these bilateral exposures have to be novated, that's the technical term, moved to the red triangle, which is called a central clearing party, or CCP. Now, just check the numbers. A had 100 million coming in and 80 million going out. So if all these positions are sent to the red triangle, 100 minus 80 means that A has a net exposure left of only 20. And the B and C, the exposures they're imposing on the triangle are 10 each. Those are a lot smaller numbers. Positives canceling negatives. That's good news. Even better news, or at least as good news, is the fact that these red triangles are monoline businesses. They're not like banks that can make loans to Latin America, real estate deals in California, take all kinds of risks, and endanger the derivatives markets at the same time. These are utilities. And as utilities, they have special regulatory supervision and rules that limit their risk-taking. And if it's done well, this is going to be a great innovation. If it's not done well, it could be a disaster because these red triangles are very central now. And moreover, if you have too many of them, it could be very bad because let's suppose that C, who is maybe Deutsche Bank, is subject to a European law, which has actually been proposed, that it may only clear in Europe. So it says, no, I insist on CCP number 2 for my deals. So anybody that's trading with me, we have to clear this in the lower red triangle, whereas A and B still clear in the upper red triangle. And there's actually a big battle going on in Europe now between London and the Eurozone over whether the Eurozone can indeed insist on having its own central clearing. If you get this proliferation of central clearing parties, look at the new exposure numbers. A and B, they don't get the benefit of netting anymore because C insisted on going through its own. So they still have 100 to each other. There's 80 and 90 into central clearing party number 2 from A and B, and you've still got C in the equation. Add these all up, there's a lot more things can go wrong. And moreover, the attention of regulators is diluted across more of these red triangles. And 2 is just for illustration. There's about a dozen of these, and the number is growing, and various nations are, in Asia particularly now, are insisting on having their own central clearing as well. So this is not going well. And I've been campaigning to fix this. Another problem is that, I'm going to skip over the details here, but that the whole foreign exchange derivatives market, which is every bit as big as the other ones that I described, except for interest rate swaps, huge, high-risk market, is being exempted from this requirement to clear for technical reasons. And I've made a submission to the US Treasury saying that the justification for this exemption doesn't make sense. You can read about it on my website if you're interested. Considering how many minutes we have left, I'm going to skip over the details. But you can ask me about it. It doesn't need to be exempted. There's no good reason for it. And it should be included because it's safer to clear than not to clear. So here's the plumbing in gory detail that with the monitoring. Now, I've made a proposal which actually I think is being adopted right now, which is called 10 by 10 by 10 systemic risk monitoring. And here's the idea. Each of these major financial institutions is going to report to its primary regulator. In the United States, that would be the FSOC, the Financial Stability Oversight Council, which is basically chaired by the Treasury. It's got the Fed, the Office of the Comptroller of the Currency, the SEC, the CFTC. All of the usual players are there. They are going to oversee the safety of our financial system according to the Dodd-Frank Act. And they're going to receive reports from these various banks on not only their own risks, but where those risks are coming from and going to. So where do the 10, 10, and 10 come from? These are to help you remember. By the way, I came before Herman Cain's 999 proposal on the tax code. I made this proposal 4 years ago. It's to help you remember it. Let's say there are 10 reporting financial institutions. Most of them will be the large banks, the same ones that I mentioned. Now, that's one of the 3 10s. The second one is, how many scenarios, how many stress tests will they report on? So an example stress test might be, what happens if the price of the euro, which is the currency in the Eurozone, goes up 25% or goes down 25%? How much do you gain or lose? Okay, so they're going to report on 10 such scenarios. One could be collapse of the US housing market. One could be a reduction in GDP growth rates. They're all going to get translated into precise stress tests to these financial institutions. So that's the second 10, 10 stress tests. The third 10 is the number of counterparties about whom you will report your stresses. So if you're JP Morgan and the stress test is a 25% reduction in the price of the euro, you will report not only how much you gain or lose, but how much you gain or lose relative to each of the top 10 counterparties that you face in the euro market, in the market for euros. And those top 10 might be different than the stress test for the US real estate market. So by virtue of getting this report from each of these 10 financial institutions, we can fill out the exposure map and find out where are the risks coming from and where are they going to. And actually, this is part of a proposal that Stanford is making to the New York campus for, as you may have heard, Stanford University is proposing to have a campus in New York. And they're taking, Stanford's provost is taking proposals for things, projects that could be done out of New York. This is one of the ones that I'm participating in, is to analyze these, or to formulate how this is done and analyze these data. Thank you.